Good morning, everyone. It's a very short presentation that's starting with something more very general macro. I would say starting a little bit with the demographic side, which is something everybody is looking at, and that's challenging a lot of the countries when we look at the European level. The funny thing is, what we try to pick on the right side is a little bit of the dependency ratios of the countries, old age and young age, in response to the working age population. And it's one of the few graphs where Germany is only a tiny dot on the left, on the upper left side, simply because the circles represent the population growth in the last 10 years, and simply Germany is the exception in Europe, as it was the only country not growing, or only growing very slightly in the last 10 years. So that is also a little bit of the background when we talk about it. But that's only part of the story if you look about the demographic challenge, because what you see is that all countries face an aging population, offset in some countries at least by a higher proportion of young people, the young dependency ratios in countries like Spain, or even Spain is quite low. On the opposite, you have countries like France, you have Norway, where you have a large proportion of young people that have to be paid for by the working age population. That is, on the one side, something you have to pay for. On the other side, that's part of your future, because that is the working age population of the future that helps you to deal with let's say problems you might have, given that the old age dependency ratio, meaning population 65 and over in relation to the workforce, is above 40% nearly in all European countries. Exception, one of the very strong exceptions is Luxembourg. That's simply because of a lot of workforce migration to Luxembourg, as Luxembourg is a little bit of a financial center for a lot of service industries in the financial world. But that is only part of the story. The other part of the story is urbanization. It's the importance of cities, and that's also what the investors are about. We're not so much talking about countries anymore. It's more a talk about cities and possibly of currency regions we are investing in. So the importance of cities is ever much growing. You see countries like UK or Belgium, where you have already a very high concentration of the population in cities. On the other hand, you have more, let's say, a little more diverse countries like Germany, where you have the federal structure. You also have France with urbanization. It is on a high level, but still you have a lot of urban centers around in France, and you still have some smaller cities that offer you opportunities. The same holds for Spain. And if you talk to some investors, they're starting to get to, especially if you talk about retail, they're willing to talk about cities outside Barcelona and Madrid again, because they simply realize there are opportunities out there in Spain that is not only Madrid and Barcelona. But overall, if this is the general background, a lot of capital, when you look at Europe, is targeting Europe, and it's not only the classical, let's say, European insurance company or pension fund money. It's a lot of capital that's coming from global sources, from Asia, from the US, and that is also one of the challenges of the European markets, because the question is, where can this capital be invested? And a lot of these international capital, especially if you look at sovereign wealth funds and these investors that want to have larger tickets, then it comes down to where can they really invest the money. And if you look at the city level with these kind of capital flows, then it's quite interesting when you look at, we just tried to look at city level data, looking at only transactions of 70 million euros plus. And there you see, if you want to do deals in this large ticket bracket, there's only a couple of cities where you actually really have liquidity, where you see transactions happening, because that is a little bit of a we looked at data for the last, I'd say 18 months about, and you see that if you want to invest in a single deal more than 75 million euros, it is London and Paris that dominate the European scene, because they are the markets where you have these large asset deals. And if you might have you have Frankfurt as one of the other cities where you have large tickets, but compared to the former cities, it's a lower growth story on GDP and workforce size. So Paris and London stand out. You have other cities with similar workforce growth, Warsaw and Munich, but they don't offer so much opportunities if you want to have these large deal sizes. And that's one of the things why competition for large lot sizes in London and Paris is heating up, because simply if you want to invest large tickets, you have to go for these cities, and you only have very few opportunities outside these 3, 4, 5 cities where you can reasonably invest the money and also be sure that you have the liquidity to exit again. Although nobody currently is talking about exiting, but if you want to have an investment strategy on the medium to long term, you have to think about exiting. And if you go for Milan or Rome and a ticket of above 100 million euros, yes, you can invest in there. But the question is, can you get out there if you want to have in 5 and 8 years' time? Who are the potential investors that will buy the asset from you? And that's, I think, is one of the issues that speaks for the global cities, because that's where you have the opportunities to trade, to actively manage a portfolio. On the other hand, if you look at the last 5 years, and also the weight of capital that came into Europe, there's only a very few markets that are not on the bottom of on the yield side, looking at the last 5 years. There's only very few cities where yields have not compressed to, I wouldn't say historical lows, because there are the cities, areas like West End, and where you still have some way, 25 basis points, 50 basis points to go for historical lows. But at least if you look at the period after financial crisis, you hit lowest levels in many markets across Europe. And the question now is, what is happening if the market is turning, especially on the capital market side? Because to a large extent, this yield compression is driven simply by alternatives on the capital markets not offering any reasonable yields. Might it be now bonds, might it be, let's say, corporate bonds or government bonds? They're also at historical low levels, and the question now is, what is happening to yields if bond rates go up and central bank rates go up? And the question now is, if you look at central bank rates, they're on rock bottom levels for 5 years now. The ECB just decreased interest rates one more step 2 weeks ago. So the question now is, when will we see the turning point? And the longer we stay on this low level, the question comes up, are there bigger, let's say, challenges in the European financial system? The ECB is not mentioning officially right now, that will keep the interest rates lower for possibly longer than we would like to have it. I can imagine that the Bank of England on August or might start to move, or the Federal Reserve might start to move into 2015 or 2016. But the question is, when will the ECB move around? And if you talk about the ECB, the question more or less is, will this be the solution? So if you move from left to right, you can say, did this be one of the solutions, that we wait simply too long before inflation kicks in, and then the European economy is still struggling, and then if inflation kicks in, the ECB will have to react, and the question is, it's choking down the economy after all, because we simply haven't solved a lot of the problems the financial system is still facing. And that is one of the things also property will have to deal with, because if inflation kicks in, yes, on the one side that might be beneficial for inflation-linked rent contracts and everything, but the question is, if the economy is not on a solid footing, do we see rental growth coming in, at least market rental growth coming in, then the challenges will remain. And on the other side, if the economy is not in a healthy state, the question is, if the economy is not on solid footing and inflation goes up, how should the ECB react to that? Because simply, if the banking system is not on a solid footing, what will happen then? Will we see inflation running away just simply because the economy is not on a solid ground, that the banks cannot take any kind of losses, possibly if interest rates go up? And if you look at interest rates and the question, how do, let's say, we did some analysis looking at office prime yields, and you see on the left-hand side, looking at historical data, that on average a 100% basis point rise in in government bond yields led to a 20 basis point rise in interest in prime office yields, everything else equal, meaning that no rental growth kicks in, so whatever. But that's the European average, and you see a wide variation if you looked at the last, let's say, 15 years. Italy, Spain seem to be less reliant on these kind of government bond of prime office yield relation, but that can also simply be the case because you had the integration process, the conversion of bond yields in Europe and property yields, that might be the overlying story for this market. On the other hand, you have France, which seems, at least if you look at historical data, had a very close relationship to between government bond yields and property yields. I wouldn't say history is can tell you everything about the future, but it tells you something about the future, possibly that if French government bonds go up, there might be a point that also French prime yields, office prime yields, and I will also say retail prime yields, might be more sensitive to these kind of movements than in a lot of other European countries. So the question is, how do investors prepare for that? Because if you see a lot of people currently investing, they're not caring so much about yields. It's simply a store of wealth, especially if you look at the prime segment of the market. But if the prime segment already is moving, then the secondary and tertiary segments will also be a little bit affected by the things what's happening on the prime market. Overall, I would say, going forward, what does it mean for investors? I would say a lot of things that we'll see happening, and that's also what investors realize, is they have to move up the risk curve simply just to get a decent return. That helps them to really generate portfolio level returns on an asset class comparison. Because for insurance companies to make a classical buy and hold buy on prime offices with a 4% yield might not yield very much to an overall portfolio of bonds and stocks. So you have to look for a little higher return side. But going for these value-add assets, the question is, it does not always mean that you have a substantial amount of higher risk. You have some opportunities in this area, repositioning or let's say reletting or reconfigurating some of the buildings where you can generate substantially higher returns than a classical buy and hold strategy, but at the same time not taking so much higher risk, but simply because you have to know the market. And so I personally would say that going forward, asset management and these kind of activities that formed a large part of a traditional real estate business, going forward will be the main success drivers for the investors in the coming years, because simply you cannot, from my point of view, say we are playing a cycle. You have to actively manage the assets you're working on, otherwise the return side will be not that satisfying for a lot of the European investors. And finally, something I've talked about in the last years very often, residential. And but the funny thing is, we had a lot of talk about residential in the last, say, 3-4 years after the financial crisis, which was quite interesting because the residential was one of the reasons for the crisis we had in the US and also in some European countries. Nevertheless, investors talked a lot about they want to be in residential, they want to invest in multifamily housing. But finally, after 3-4 years, we've now seen the deals happening. At least a couple of deals are happening. APG took a share in Sato, a Finnish residential builder. You've seen some transactions in the UK private rented sector. You see now things changing in the Dutch market. So finally, it seems as if the residential segment really sees the bigger deals going on, not only in Germany, where we have some where traditionally we have seen a very liquid and large residential market. So the question now is really, will this be something for the long run? Are investors able to find the product they wanted to have? Because in most markets, if you look at the Dutch market, or if you look at even some of the Nordic markets, or Ireland, or even Spain, it's a lack of product that holds back a lot of the investment. So the question is, can we now, or will the countries use the momentum investors have by going for some kind of low risk bond type investments in residential? Will they use this momentum in a way that product comes to the market? As house prices are turning in some of these markets, the question now is, how fast can be the product out there for institutional investors? Otherwise, I think we won't see a large wave of capital in residential, because simply the product is missing, and we see investors talking about it but not really exercising a lot of their activities, because simply they don't find the product, or they are lacking the skills to do it. But as for offices, also residential, it will not be the classical buy and hold strategies. It will be more of something like buying a larger portfolio, selling off unit by unit parts of it, keeping parts as a rental portfolio, and possibly redeveloping, repositioning parts of the stock by upgrading or whatever. So also in Resi, the question is about strategy and not about the classical buy and hold strategies the investors had. And there I think also the institutional community has a long way to go, and the learning curve, we're at the start of this point, especially if you look at a pan-European level. You had players in different countries that did it, but the question is, on a pan-European level, you only have a very few companies that have a pan-European residential strategy right now. But I strongly think or believe in that it will emerge in the next years. But because if it's not emerging in the next years, I think the market will have turned in a way that simply the opportunity is gone and it's much harder to develop it, right, as it is right now. And I think that is a little bit looking forward what will happen. So the interest rate environment, from my point of view, is the crucial driver, and the question will be when will it turn and how will this affect investors, because a lot of the international capital might not be that reliant on interest rates of the ECB, but looking at European level, ECB interest rates are one of the drivers for many continental European investors, and the question is how will they mix up with regulation going forward on the investment streams. Thank you.